To the all-important economic survey. The document has raised the red flag on FY17 in several counts. It says this year's fiscal deficit target of 3.9% is achievable, but next year looks challenging. It's also pegging FY17 growth at 7.75%, so that's very clearly under 8%. Let's get in, Latha, to understand more about the economic survey. Latha, what were the key takeaways for you?
Well, one of the key takeaways clearly is an acceptance that growth is not coming in a hurry. There were two separate statements on growth that I saw. Now, you must remember we are reacting to just single sentences. We haven't been able to read the document. It's a 300-page document, and if you count the tables, it's much more. So what we are getting is just initial flashes from our reporters. It seems to come to terms with a lower growth of 7 to 7.5 for this and the next year, and in the medium term to 7 to 7.75. So it looks like the 8% growth is postponed to probably after 2 years, not anytime soon, not expecting it next year or perhaps not even the year after. The other part is that its accent on fiscal consolidation as something that must be achieved for reasons of credibility and optimality. Credible so that what we say is accepted by those who are buying Indian bonds, and optimality because if you put in more fiscal deficit, you sold more bonds, they will be bought at higher and higher yields. So it's not even optimal to have a higher fiscal deficit, not even in a financial sense very sensible for the government. But there is also a statement that the medium-term fiscal timetable needs to be reviewed. This can be seen any which way. It can mean that you have to reset and not expect 3% the year after, which is the original timetable, but maybe a new timetable with states and central fiscal deficits consolidated. We don't know. That's another flash that I'm reacting to. A third set of flashes was about banks, and it said that two balance sheets are broken. Corporate India's balance sheet is broken and banks' balance sheets are broken. They are the guys who lend to corporate India. So 4 R's are needed to put this together. That is, first, recognition. Recognize that these are bad loans and that they will never be paid back to the extent that they are. So recognition of NPLs. 2, recapitalize the banks. Therefore, to the extent that you are taking away the bad loans, they have to be recapitalized. A third is resolution. Loans that are not going to be paid back should be sold out. If a steel plant owes you 30,000 crores, they're never going to make that money in the next 30 years. So you sell off that steel plant to probably 3,000 crores, 5,000 crores, 10%, 20%. So resolution. And the fourth one, reform. That is, reform the corporate sector so that they don't think they can get away with this year after year or cycle after cycle. So probably that points to the bankruptcy code.
Okay, all right, Latha, thanks so much. So a very clear mention about banks, and perhaps that's giving traders more hope that the government will come out with a bigger recapitalization plan. Of course, that's what CNBC TV 18 has also been reporting. Now let's get you some opinion what economists at JP Morgan and HSBC make of the economic survey.
Full marks to the economic survey. They've been realistic, and I think the 3.5% will be music to the bond markets here. The bond markets had a very rough couple of months. I think this will be a positive surprise because markets have basically priced in some slippage, so there will be a surprise here. I think the question is going to be how this gets done. You would hope that the 3.5 is accompanied with realistic assumptions on the tax side, and it's done because some part of the pay commission is pushed out, which is what happened in the rail budget. Our sense on the rail budget was you did have some special allowances that were pushed out, which ties in with Pranjal's point. So to the extent that some of these wages are pushed out, you reach a number of 3.5, very, very positive.
It's a very fantastic growth number, very realistic, very credible, something between 7 and 7.5. We are ourselves at 7.4, flattish growth compared to last year, so we are happy to see this number here. Moving on to inflation, inflation of 4.5 to 5 looks quite low to us. Even if they meet the 5% target by March 2017, the average of the year inflation could be much higher. I think it could be somewhere in the 5.5% range. Speculating a bit, reading between the lines, it could mean that the government is probably not going to have the HRA allowances this year. Maybe they'll defer it to next year.